Hey everybody, welcome to this free edition of our Trader User Group. This is for the weekly trading week, weekly trading week, ending November 17th, 2023. I'm Preston Brent. Thanks for tuning in. Well, the week's theme is, are we on for a Santa rally? Well, let's take a look at the markets and just kind of see. It certainly seems that way, doesn't it? Over the past 3 weeks, markets have been up very, very strong, okay? If we look at it, we've been building on these movements, and we're up just in these 3 weeks about 9.63% in the S&P 500. Capped out a gain this week, as you can see, of 2.24%. Year to date, we're up 17.5, a little over 17.5 for the S&P. NASDAQ's up almost 35% for the year. The Russell came clawing back over these past 3 weeks, had a really good showing, moved back into the green, as you can see, at 1.89%. And the Dow, 5.43. So the Russell is still lagging dramatically, but at least it recovered, being in the red about 7% just a few weeks ago. But it outperformed its growth counterpart for the week. And we're seeing that now that earnings is winding down for Q3, we're going to be focusing a lot on things like inflation. And speaking of inflation, that came in this past week. The headline CPI number came in unchanged at 3.2% year over year, but the core fell 10 basis points to 4%. Still a lot higher than the 2% the Feds want, but the markets liked it. Okay, I mean, the price action really gapped up at over 50 points at open and closed the day very strong. And what we're seeing is it's the slowest pace that we've seen in over 2 years for the core CPI, which of course that's what the Feds follow. And then we got the PPI that also came in Wednesday, and it surprised to the downside as well, like the core CPI did. So all of these things bode well for the markets. Although retail sales, it fell just 10 basis points in October, but it was less than expected. So everything came in better than expected. Okay. And that tended to really goose the markets really nicely. And with all of the inflation coming in, we saw the 10-year interest rates fall. I think it hit over the past 3 weeks. It was up over 5%. Now it's down to 4.40% on Friday. It's an intraday low. It's the lowest it's been since mid-September. And we're seeing the Fed Fund futures pricing in 425 basis point rate hike cuts. Or rate hike, a rate hike cut. That did not make sense, guys. How about 425 basis point rate cuts through all of 2024? Now, the Fed dot plot is not suggesting that, and that's where we're going to get some interesting action here on December the 13th. Okay. At this meeting, the Feds are going to revise their dot plot. They only do that once a quarter. And remember, their last meeting, the end of last quarter, where they came out with a dot plot, the markets were expecting 4 rate cuts, and they only got 2, and the markets fell. So we've got that opportunity we got to watch very closely. And we will get another CPI number before the Feds meet on December the 13th. Okay. So we've got to, stay on top of this. But all in all, it was fairly good. You can see the PE trailing ratio is at 20.17, and the forward is 20.17. I mean, they're literally flat, the PE ratio. You can see the dividend yield at 1.56, 10-year treasury, as I said, 4.4. But it's still higher than the dividend yield of 288 basis points higher, right? The earnings yield is at 4.87%, and the real yield is 167 bips. That's over the earnings yield in the S&P, over the inflation rate by 167 basis points, or 1.67%. So that's good. You can see the VIX closed out the week at 13.8. So we're back into the low teens right now for the VIX. The prior week, it came down just a little bit. And you can see the best performer for the week was real estate. Obviously, with interest rates falling like they are, the real estate sector loves that. Staples, you can see, was the worst performer for the week. Technology, rounding out best performer for the year so far as we go into the last 6 weeks or so of the markets. And then utilities bringing up the rear at 28.74%. And of course, if we come over and look across the pond, let's just take a look at Europe. The ECB president, that would be Christine Queen Bee Lagarde. She was the president of the IMF and then took over the ECB. She said basically that the ECB policymakers expected inflation to pick up a little bit starting next year. However, she did say that even if inflation accelerates, another interest rate increase may not be required. She's sending the signal out that they're probably going to stand pat. Now, that's what the market theme is also here in the US. Inflation is in the rearview mirror. The only thing we got to focus on now is no more rate hikes. When are they going to start cutting? Now, the Feds, keep in mind, they're slightly different. They're saying the rate, we're going to stay higher for longer, and we may not start cutting till the middle of next year. So there's going to be a little bit of a seesaw battle here going into the next Fed meeting on February or on December 13th, like I said. But the ECB is picking up on that mantra, saying the same thing as well. You can see everybody across Europe, the Euro stocks, the 50 largest companies in Europe, are up, had a strong week, over 14% year to date. The FTSE actually moved back into the green with a strong showing this week. The CAC 40 still solidly in the green, and the DAX 14.33%. So all across Europe, fairly strong. And of course, if we go over into the Asian markets, you can see in Japan, their Q3 data showed that the economy shrunk by a worse than expected 50 basis points, although the Nikkei had a very strong week, okay? And we're seeing that with inflation up, the yen very weak, and basically they've had a sluggish global demand on their exports, okay? But Japan just got approval to put more stimulus in the economy, and you know how money just loves more money, especially markets. Markets love it. So that's helping the Nikkei. It's up 28%, almost 29%. That's unheard of for the Nikkei. Very strong bounce this year. And then, of course, China in the red and Hang Seng in the red year to date. China's hurting this year. Their official data for October kind of offer a little bit of a mixed picture of the economy. Industrial production, retail sales grew a little bit more than forecast from a year earlier, yet their infrastructure growth is coming in less than expected, and their housing market slump deepened in October. Investment in property development fell by an above consensus average of 9.3% in the first 10 months of this year. Okay, property sales also slumped just slightly under 8% for this year. So they're hurting. I mean, but again, the government over there, the People's Bank of China, is injecting more money into that economy as well. So really the only two countries that are putting money into the economy is China and Japan, right? So that's kind of helping these guys out. But year to date, China is still hurting. Exports down, imports down, consumers not spending much. They're really not coming out of that post-pandemic like other people, but they were locked down for like almost 3 years. So I think the consumer is about a year behind in a lag in spending over in China from what we're seeing elsewhere. Okay. So that's a little bit about just a real quick dirty run on where we are in the markets. I'm going to show you these charts. So let me just switch over here real quick, give you a quick update on, let's start with the E-mini S&P 500 futures. We'll look at the major markets, of course, and just kind of see how they're playing themselves out here. And it takes another 5 seconds. I think it'll show up on your screen. So it should be showing up now. So if you look at it, you can see here that the S&P 500 E-mini futures is in my next major resistance zone. You can see it's an Elliott Wave 3 up. You can see that huge thrust here in price action. And if we look at volume, you can see volume is down. That purple line is a 5-day moving average of volume, and the blue line is a 20-day moving average of volume, a daily average. And you can see they're both pointing lower, with the purple lower than the 20-day. So the 1 week moving average is lower than the monthly moving average, and that suggests this move up here, there's a lot of short covering. We've had a ton of short covering in the market. I mean, and that is just, the sun and the moon and the stars lined up. And you can see here where everything just pointed for a rapid move higher, all right? You can see we took out the prior pivot high. This is the B wave of the Elliott wave. We took that out. had a huge day, and then now we're challenging a prior pivot point high at a C wave earlier this in September. All right, this is going to be a sticky wicket to get over. You can see we were down over 11% intraday in the S&P, and this came up basically right on October the 27th. All right, now hang on one second. Excuse me. So this is a little bit about what I'm seeing here. I think the odds, it's going to be, are we going to take out the high for 2023, which was made on July 27th? We were up 19.81%. I believe we can if we get cooperation by inflation, what it looks like, but the biggest cooperation we're going to need is the Feds on December 13th. Momentum may take us higher, but then when we meet the Feds, if we do that and we have a good Fed that the dot plot shows only, it shows matches the market expectation of 4 rate cuts, then I think we're going to take this out, make new 2023 highs, and then we're going to move up into no man's territory here. I do not believe we got enough momentum to take out and make new all-time highs this year, but if the Feds cooperate, we're moving up. Now, when we were down in this area here prior to the Fed meeting, I said we're going to need the Fed to take out and clear this prior pivot high. And we did, and the Feds just, gave us what we needed, and then away we went, right? Now, we're going to need the Feds again to clear this area here, right? And this area runs from about 4,500 to about 4,560. We do that, we're going to be up to 4,600, challenging the highs for the year. Okay, so that's a little bit about what I'm seeing in the EMinis. And then, of course, if we look at the NASDAQ also had a strong showing over the past few weeks. You can see here NASDAQ actually is challenging the highs for the year. I mean, we challenged it intraday, but not quite. We had a high of 16,049.50. The high for this year is 16,062. So just a few points south, but we're going to chop around here. I think momentum in NASDAQ can carry us higher, but you can see all these different resistance points set by different times, 2021 closing, 2022 high, and then all-time high, right, set in 2021. So we got a ton of resistance in the 16,000 range. All right, and we're right at 15,879 when we close. So a lot of overhead resistance up here, and it's going to take, the sun and the moon and the stars to clear through all this hurdle up here. I think next year, 2024, is going to be a very interesting one. I think there's going to be a lot of chop. Vol is going to stay higher, and I still think we have to watch out for a possible recession. All right, and as I told our members, we got a couple of things that we're watching on economic data, and if we hit that, it'll be a pretty good heads up that we're going to get, at least at a minimum, a minor recession, right? And remember, even in a minor recession, you get the S&P pulling back 10 to 15%. A mid-tier recession, we're just going to get 15 to 20%. A hard recession, 25 to 35% roughly. So I'm not expecting that. I am expecting kind of a mild recession if we do have one. And that's going to drive what the Feds are going to do. So this is and you can see these circles here were my targets for for NASDAQ. We hit them pretty close. We're over these key levels here, as you can see here. We've even taken out the prior pivot high here. That'll be a nice pullback point for the NASDAQ. And of course, if we look at the Dow, it's back in the green again as well. You can see how we were actually, as of October 27th, we were in the green or in the red, way down here, right, for the Dow. And then boom, we just had this huge move up. And if we look at volume on the Dow. It's fallen off the table. And generally when you see a big move higher with very limited volume like this, that tells you that there's a lot of short covering and not a lot of conviction in new money coming in. And of course, we got this prior pivot high like the S&P, we got to bounce through, right? And you could see, though, the Dow did not hit official correction territory. It's down about 9.58% back on this day, back over here on the 27th of October. Okay. Now let's look at the Russell. This is the one that I was really happy to report on. The rut really took off. I mean, you can see it's backfilling and testing the closing price of last year. So we're barely in the green, but it doesn't matter. We moved off these lows that were made again on October 27th. That was the low point for most indexes this year. And you could see that the Russell was down a little over 7.5, 7.7, 7.8%. And then we just had this big move higher, bounced off the 50, came down, and we moved back up, and then the Feds gave us what we needed, and then we got some participation in small cap. All right. Keep in mind that about 30% of small cap stocks in the Russell are not making any money. And when interest rates start rising and they keep going higher, they stay higher for longer, it's going to really punish these companies. So we're going to see how this plays itself out. Right now, we're sandwiched between the 50 and the 200 EMA. So we're going to watch and see where this goes. If you look at the Fang Index, not the Super 7, but the Fang, we made new highs. I have to adjust this for our members for tomorrow evening session. But you can see how we made new highs, right? And if we look at our Magnificent 7, we're throwing in Tesla and NVIDIA. You can see here we're challenging the highs. And even the pullback, we were back about almost 16% on these lows here, again, on the 26th, 27th time frame. But now we're challenging the July 19th highs. And that's up here at this level. This is a custom index that I made of just the Magnificent 7. But also, along with the Russell, which seems to be going correlated fairly closely, is the equal weight SPX. Look at the equal weight SPX. I've got to adjust this one as well, but we were in the red back on October 27th, and now we've moved back up into the green. This is the other 493 stocks that make up the S&P. Not by a lot. In fact, my target was much lower. And I don't know if we're going to get down there now because we're getting, as I said, charts were indicating we were going to move lower. But then when you get cooperation by inflation, and then more importantly, the Feds, that'll put a crimp in any downside action if the Feds want to play. And they are so far. We're going to know on December 13th that they just how serious they are in playing with us. And then, of course, if we look at the VIX, you can see here it's back into the upper, or actually it closed in the upper version or zone of the green zone. And you can see I don't see us going much lower than that this year, maybe in the 12s, but I don't see us going much lower than that. But you can see over here at the end of October when things just were what seemed like their worst. This is when we were adding to some of our positions here, and I was recommending this. The old saying with the VIX, when it's low, it's time to go, and when it's high, it's time to buy. Well, for those options traders, you know what I'm talking about, and that's kind of what we did here. And we're just playing this thing nicely so far this year. Okay. If we come down here and we look at treasuries, we'll look at the bond market. The markets are loading up long bonds. You can see here where we hit my target, both time and price, perfectly. Right around 107 in just 4 ticks. We've taken out the 50, and then we're just holding down here. Now, my chart is indicating to me that we can actually move a bit lower. If I were to just put this on here like this, you can see this would suggest that if we do move down here, we're going to have interest rates move higher. Now, what can move rates higher right now after we pull back so strongly on the 10-year? That would be the Feds. If they indicate they're going to stay higher for longer, the markets are expecting 4 rate cuts, and the Feds say they're only going to do 2 right now, or the dot plot maybe indicates 3, but that's it. We got to see how the market price is going to react. The last time we had that divergence, markets reacted negatively to it. So, and that's just coming up in about 3 weeks or so. 3.5 weeks. So we'll see, or 4 weeks in the middle of December. So we'll see how all this plays itself out, guys. And then, of course, if we look at currencies, the dollar was hard down because interest rates are coming down. Look at the dollar. It's coming back down. It's just barely in the green again for the year. All right. We were hard up. And my action, the chart's indicating we should move way up much stronger. That would indicate higher rates, lower bond prices, and more trouble in River City for the markets. So again, the only thing that can move this right now is going to be the Feds. Okay. And if we look at the euro, well, the euro just took off, right? You can see here with the euro, away we go. We got the 50 cross and the 200. So this triggers the trades that we like in the euro. Members, I'll go through this a little bit more detail Sunday evening. If you're not a member, I highly encourage you to come in and check us out. We're doing well this year. And of course, if we look at the yen's the other one that we like, longer term. You can see here we blew through my target, which is around this level right here. We're going to come up and check it. We got to get over the 50 EMA, see it hold, and then we're off to the races there as well. Okay. And then, of course, if we come down and look at gold, well, interest rates coming down have been a little bit bullish for gold. You can see where it's kind of dancing around the 50 EMA. It only closed below it one day, and then it's made it back up. Gold right now is going to be in a sideways pattern. Too choppy for me. We hit my target and then we bounced hard off of it. And now we're in this sideways pattern. I think gold is just, as long as interest rates are coming back down and we got the turmoil, the political and geopolitical turmoil that we have, then gold's going to have a bid. But if interest rates start moving back up, you're going to see gold come back down again. All right. If we look at copper, well, if China starts to stabilize, you're going to see copper stabilize and move higher. This chart right here would indicate copper is going to move much lower, right? I just put a little symbol on here to give me an idea where it's going to go, to right down in this area down here, right? And this was the longer term time frame for copper. We never got down there. But you can see if China continues to stay in the doldrums, then we can definitely roll back over again. I want to see us move above and maintain the 200 EMA before I start talking about copper to the upside. Okay. And then, of course, if we look at energy, well, what can I say about energy? It's been very choppy lately. All right. But look at it. We're underwater. We were up here. We hit highs back over here on September 27th. We were up 18%. Now we've fallen dramatically from these highs. I mean, just crazy. I mean, if we look at it measured from the highs, just a month or so ago, we're down about 20%. It's bear market already, right? And then if it's measuring it from the closing price of last year, we're looking at right about 6% down, right? Down at these levels down here, I like a little bit of a bounce back up, and then be careful of a rollover. All right. And then nat gas, if we look at where nat gas is doing, it had a hard down day on Friday. And we're at the lower boundary here. So like I told our members, and what I'm suggesting is once it blows through the 50 EMA below, we got to be careful of more downside action. All right. Let's just watch this very closely. All right. We had a short signal back over here when we got too far out of the regression channel, and now we've been long this whole way, playing a special strategy. I like using options on the futures market, but right now it's no man's land. I would have taken profits, or I was suggesting we take profits sooner and stand on the sidelines and wait, and let's see how it plays itself out. All right, everybody, that's a little bit about where we're sitting right now in the financial markets. Members, I'll see you Sunday evening. Just as a reminder, next weekend is a big U.S. holiday weekend. It's Thanksgiving on Thursday. Markets closed all day. Friday, the futures market will open Thursday evening at 6 p.m. It'll close Friday at 1 p.m. along with the rest of the equity markets, which will just be a half a day because Friday is Black Friday here in the U.S. So a lot of shoppers are going to be lining up both online and at stores. So that'll be a half a day. So there will be no weekly roundup for this next weekend on this holiday weekend. Have a great weekend, everybody. Members, I'll see you this Sunday evening. Ciao, folks.